1 in 4 people in British Columbia are living paycheck to paycheck, and it's likely going to be even higher than that. And not only that, you're seeing more and more of these third world type rentals that are popping up and could even be in your local neighborhood. So we'll get into that as well. So almost 1 in 4 British Columbians live in paycheck to paycheck, according to this survey. Thanks a lot, Terry, for sending this. It's again just another one of these concerning surveys, but the likelihood is that it's even higher than this. And when you get into the nuance of the places, well, it turns out to be true as well. So as the cost of living continues to rise, many Canadians are looking for ways to save, which means more cooking at home. A customer pushes a shopping cart full of groceries from No Frills in Toronto. So another new survey is showing how many British Columbians are struggling to make ends meet and the toll it's taking on them. According to the National Payroll Institute, just under a quarter of British Columbians say they're living paycheck to paycheck. But get this, in Victoria, the NPI found 45% of people are living paycheck to paycheck. 45% of people, again, in Victoria, are living paycheck to paycheck. And this was one of the places which had the highest amount of credit card debt. Of all the cities in Canada, one of the highest for credit card debt. So what does that tell you? Are a lot of people just putting all their expenses on a credit card? Well, it certainly seems like it. And you know, the contrast between like 2021 and 2022 in Victoria when I was there in the summer is unbelievable. You know, 2021, there were a lot of people out and about eating at restaurants and stuff. 2022, a lot of those restaurants had shut down and there was nobody in the restaurants eating out anymore. So the interest rate hikes, they really hit fast in Victoria especially. Only 17% of Vancouverites report this, possibly reflecting the city's higher average incomes, though the cost of living still remains a concern. About a third of people in the province say they're overwhelmed by debt, with nearly 3 in 5 saying they're concerned about housing costs. And you know, the debt amounts are just crazy. I just want to play you this video. So I'll just play you this.
Crazy. I am logged into my loan account and we've officially owned this house for a year. So every month for a year, 12 months, I've been obviously paying the mortgage. What's crazy is when you log in, it tells you how much is left on your mortgage. And our mortgage has gone down the equivalent of what I pay in 1.5 months, every single month after paying for a year. The rest is just interest. It just poof off into outer space. Basically like paying rent. You never see that again. It doesn't do anything.
So it's really interesting, isn't it? Because a lot of people, they don't even know that a mortgage is the only type of loan where it's front loaded with interest. So you're basically paying all the interest down before you really start paying a lot of your principal off. And the reason the bank does that is obvious, because they can for a start off. The loan is obviously so long as well. So they've got to take some of that risk off at the start at least. But you know, people don't even realize this. They don't even understand this. And a lot of people don't know that they've barely paid anything towards their mortgage. And a lot of these people have been rushing to buy at high prices and high interest rates. You know, in Calgary, Edmonton, Halifax, Montreal, Quebec City, Ottawa, there are so many markets where people were just rushing to speculate, and they were buying at these high interest rates and these high prices as well. So what do you think is going to happen if the prices reverse in those markets and revert to mean as they are in some other places like Toronto? So Toronto ranks 3rd in Canada for largest credit card debt per capita, according to this report. So it's interesting. So Barrie has been named the city in Canada where residents on average have the most credit card debt, $3,521.54. Behind that is St. John's, Newfoundland and Labrador, on average $3,500 $1,451.95 in outstanding credit card balances. So these are people that aren't paying their balance down. And you've got to remember, most people are paying their credit card off every single month. So the actual amount of debt that these people have on credit cards is way higher. It could be over $20,000 because you're talking about a smaller amount of people, and this is split across everybody. You've then got Peterborough, Ontario, which is 4th in the ranking. You've also got 5th is Kelowna. Then you've got Brantford, Ontario, Kingston, Ontario. And then in 8th place, you've got Calgary, and Calgary actually holds the top spot for delinquency rate. Non-mortgage delinquencies over 2% now in Calgary, the highest in Canada. And that's also been the boom town that speculators have absolutely flocked to. So it's very interesting. And then you're also seeing things like this that are happening. And this is because Canada is importing the third world. What people actually have as their standard for accommodation is a lot lower for these people. And basically, it is allowing landlords to get away with third world living conditions in Canada, which is popping up everywhere. And this Blog 2 article here is just one example of many different things that are often plastered all over Twitter, where you've got all these kind of disgusting things. So finding an affordable place to live in and around Toronto is no small feat, and the latest nightmare rental listing to make the rounds online is showing us finding one that's actually livable is even more of a challenge, whether it's being charged $525 for a mattress in the hallway, cramming 7 people into a 2-bedroom apartment, or bizarre rules that make life miserable. There's seemingly no end to the weird, woeful, and frequently downright disgusting rental listings going up across Ontario these days. And again, that comes back to the type of people that are coming to the country, and their standard of living that they're coming from is a lot lower. So this might be quite normal. But obviously what people don't understand is this drags down the standard of living for everybody, because if somebody can put 7 beds in a 2-bedroom apartment and rent that out legally, then the whole investment equation changes, because in a financialized housing market, you have to, unfortunately, I don't take any pleasure in this, look at it from the investment side of things, because unfortunately, like I said, it's become completely financialized, the housing market. So credit market debt to disposable income has peaked. We've been through this numerous times as well. And one thing that we really want to keep an eye on here is for consistent declines in credit. Now, in my opinion, this is only going to happen after some sort of financial crisis, GFC 2.0. You're not going to see this happen without that. And then that's when the banks are going to pull back. But you really want to look at this carefully. And we did actually see this, funnily enough, but it did not continue onwards, where they did pull back on lending just for 1 month into January. But that could also just be to do with the actual demand. Like, there wasn't the demand there for loans. So basically, it didn't grow by that much. But if we see consumer credit that is consistently declining, that's going to be a real sign that credit tightening is happening. But right now, with credit card debt hitting new highs, you have got deleveraging happen when you look at the ratios. It's very obvious when you compare to like the United States during the GFC that the deleveraging has begun. But we've really got to look at indicators like this. And also we've got to follow obviously what's happening with the average house prices. But again, this isn't adjusted for inflation. So you might look at this chart and go, well, housing prices haven't come down that much. Well, housing prices are likely down at these pre-pandemic levels right now when you adjust them to inflation, because the real rate of inflation that we've seen over the past 4 years probably surpasses 50%. So then you have to take 50% off where we're at right now to get to that real inflation adjusted average home price. So anyway, guys, I want to thank you so much for watching this video. If you've enjoyed this video, I'd highly recommend that you check out this video here. If you're looking to protect your privacy, you know where to go. Go to expressvpn.com/marketmania, affiliate link in the description, and I will see you in the next one. Take it easy.